Good evening, class, and welcome to our advanced taxation class for today. The topic for consideration is oil and gas taxation. Now, this topic is popularly called petroleum profit tax, but it has been renamed to oil and gas taxation. What are some of the things that we stand to gain? We won't be talking too much on this topic, but I will advise that you read every details of this topic because this topic alone contains everything that you need in every other topic. I repeat, this topic alone contains everything you need in every other topic. So please take your time to read. But we're going to concentrate on the general overview of oil and gas industry in Nigeria. We'll look at the fiscal operating arrangements in the upstream sector. We'll look at the upstream activities, what makes up the upstream activities, downstream activities. We'll look at some definition of terms, administration of the Petroleum Profit Tax Act. We'll now look at nature and classification of income, nature of cost and classification of costs, the petroleum profit tax, the adjusted profits, the assessable loss, loss relief, chargeable profits, qualifying capital expenditure, then the format for computing petroleum profit tax, offset. Then we'll now look at some other things. Just a moment, please. Hello, good evening. I'm fine, sir. Oh, my light really did my phone went off. Once again, I welcome you to the advanced taxation class. We are taking petroleum profit tax, now renamed to oil and gas taxation. I mentioned before that you should read every section of this topic because whatever you read in this topic alone can be applied to every other topic that we've discussed. So don't take this for granted. But we're not going to look at everything here because we have discussed them before in other topics. We're going to look at a few things. Today will be all talk theory. I will have one more class with you where we'll study questions, solve questions, computational questions. And so that will be all for the topic. So now let's see the purpose of this lecture is to make students appreciate what the development is in the Nigerian petroleum sector, to know the meaning of upstream and downstream activities, to be conversant with the terms used in petroleum industry, and to, of course, know how to compute petroleum profit tax. Now, let's go. Now, Nigeria produces about 2 million barrels of crude oil every day. And Nigeria is ranked among the top 20 largest producer of oil in the world. Looking at the Nigerian economy, 60% of government total revenue and more than 90% of its foreign exchange receipts come from the oil sector. And everybody depends on oil. And so there is this saying that oil is the new gold. Now, in addition to its crude oil reserves, Nigeria is blessed with abundant reserves of natural gas. And a large deposit of gas has led many experts to describe the Nigerian petroleum field as a gas province with some oil in it. So you've heard of the liquefied natural gas. So these are the people that, the LNG are the people that extract this natural gas. Right? The proportion of natural gas in conjunction with crude oil is relatively high. So sometimes you will see crude oil and associated gas. Within the last decade, some of the existing operators in the petroleum sector in the joint venture, when we say a joint venture, you learn about that. These people are in joint venture with NNPC, though NNPC now have now renamed to NNPC Limited. They have now embarked on a number of gas utilization projects. Most of these projects are in relation to associated gas discovered in the search for oil. So what it means is that you are searching for oil, but in your search for oil, as you are getting oil, gas is associated with it. While unassociated gas deposits are being reserved for future investments. All right, so let's go. We will not be talking about the overview of the oil and gas industry in Nigeria. You should read that. It makes for a good read for you. So What are the roles of regulatory agencies in the oil and gas industry? We have the NNPC. The NNPC was established by an act of number 33 of 1st April 1977. And NNPC is the sole authority over petroleum activities in Nigeria. So they oversee petroleum activities. Now, NNPC has some subsidiaries. That means NNPC is a parent company. It has some subsidiaries that are involved in exploration of oil, production of oil, transportation of oil, processing of oil, refining and marketing of crude oil and derivatives. NNPC do not do that, but they have their subsidiaries that do that. Now, what are some of these subsidiaries? We have the National Petroleum Investment Management Services. Now, this is the investment arm of NNPC, which administers NNPC's share of joint venture operations. So when you hear joint venture, this is NNPC joining forces with oil producing companies to come together to explore oil. Now, it is this arm of NNPC called NAPIMS that do the joint venture operations for NNPC. Then there is another one called the Petroleum Product Marketing Companies, called the PPMC. This is the subsidiary that is responsible for selling of refined petroleum and finished products, which include diesel, engine oil, gasoline, and other derivatives. Then there is another arm that is called the MPDC, Nigerian Petroleum Development Company. They are engaged in exploration, appraisal, or drilling of appraisal well, production, abandonment, and so on. Then another one here is the Nigerian petrochemical companies in Kaduna and Warri. Then there is the refineries in Port Harcourt, Warri, and Kaduna. So we won't be talking much about them. We will now go straight to some of the important things here. Fiscal operating arrangement in the upstream sector. Now we have the joint venture. Now, what is a joint venture? The joint venture is a contractual agreement whereby two or more parties undertake an economic activity which is subject to contractually agreed basis of sharing control. In other words here, there is an agreement between NNPC and other oil producing companies to undertake the exploration of oil, and there will be sharing, control, and profits on the agreed profit sharing basis. Now, no oil company usually do business on their own. You must do it in joint venture with NNPC. This is because here, the oil business, upstream business, is a huge capital investment, and NNPC must be involved. NNPC usually take up a majority of the venture. So you may see a joint venture in which NNPC and 4 other companies perhaps 4 other companies might be doing a joint venture. An NNPC might take up 60%. And each of the 4 companies might be taking up 10%, making the remaining 40%. So NNPC usually take up majority of the venture, while the oil producing companies will take up the balance. One of the parties in the other ventures will be given the responsibility to operate the venture. Let's take, for example, Shell. Shell may be given the responsibility to operate the venture. Let's say perhaps there are other companies associated with them, joining business with them. Let's say Chevron, Ajib, and AP. Let's assume that they are joining forces with Shell and with NNPC. NNPC takes up majority, Shell being given the operating license to venture the operation. That is, they are the one that is taking the lead in the production of crude oil from where they're asked to produce. So Shell, in this our example, is called the operator. The operator is the one that conducts the operation in the joint venture. And this includes drilling of oil well, the production of oil from a field or tract. And in most cases, in spite of the NNPC majority shareholding, it is this oil producing company called the operator that is the person in front when matters concerning that venture is talked about. Now, what happens? The operator drills the well, do everything involved, and then now strike oil. When they strike oil, it is now time for them to bring their resources together and do this exploration, win the oil from the ground, and do business. And so this operator will call for cash. It is called cash calls. Now, money is needed to run everything because now they have seen fuel or oil in commercial quantity. And so the operator will now call for cash. And everybody will now be required to bring cash. NNPC, being the majority of the shareholder, will bring a large portion of the cash. Everyone will bring cash in proportion to their holding. And so there's something called cash calls. Who call for cash? It is the operator whenever there is a need. Now, when the whole thing has been done, each party in the business will lift up oil that is assigned to them in proportion to the interest that they have invested in. It could be in proportion to their cash calls, it's in proportion to their investments. An NNPC will lift the majority. But of course, NNPC will not be able to lift everything. And so the operator, under the special arrangement with NNPC, will be asked to sell on behalf of NNPC any parts, any balance that NNPC could not lift. So the NNPC will tell Shell, we are unable to lift so and so number of barrels that belongs to us. Sell it for us and pay the proceeds. to NNPC's coffers. Of course, they'll be doing it for a concession. Now, that is what we call the joint venture. So most times in your question, you will be seeing a joint venture sort of question. And when we are seeing that, maybe the person you are seeing being preparing the account is the operator. Now, apart from joint venture, there are other forms of business contracts that exist. And the next one is called the production sharing contract, also called the deep offshore inland basin. I usually term it PSC. So in production sharing contract, which I call PSC, the producing companies enter into agreement with NNPC to produce crude oil in a particular field. Now, there is a difference between the joint ventures and the NNPC. Here, in this, there's a difference between joint ventures and PSC. The PSC people takes more risk. The operating expenses for the petroleum operations will be met by each of the operator. And now, in this case, there is nothing like cash calls. If you strike gold, you fund the contract 100%. NNPC will not share in any funding. Unlike the joint ventures where NNPC will be required to make some cash calls, and they will not tell you to sell whatever they cannot lift. Here, in the joint venture, if there is a profit, NNPC makes profit with it. If there is a loss, NNPC makes loss. But in PSC, NNPC's money is not involved. If there is a loss, the loss is on your own. But what happened? When oil is recovered and won and produced, NNPC will not come. Remember, NNPC did not contribute a dime. But when it is time, they will come. Operator, you are operating in Nigerian territory, right? Yes. And so because you're operating in Nigerian territory, you need to pay royalty. And they will calculate the royalties. When they calculate the royalties, they will convert it into barrels of oil. Let's say the royalties happen to be $20 billion. What they will do now is, what's the price for 1 barrel of oil? They will determine that. How many barrels of oil will give you the 20 billion royalty? They will calculate it, and they will not say, so and so number of barrels is set aside as royalty oil. So it means that NNPC is coming to collect royalty, but they will not collect it in the form of cash. They will collect it in the form of oil. So that's royalty oil. That belongs to NNPC. NNPC is acting for the government. They are taking their royalties. All right. Now, the royalty oil is removed. They will now ask the operators, how much did you spend in all of this? What is your operational cost? They will not tell them this is the cost we spend, maybe $50 billion. NNPC will say, okay, how much oil is what that costs? They will now calculate the number of barrels of oil that is what that costs, and it will be termed as cost oil. And so here, they will shift the oil to one side. This is for your cost. No physical cash is involved. Now, then the remaining oil, they will now calculate. If you sell everything, what is going to be your profit? Or what is going to be your tax? What is going to be your tax? You calculate your tax, and they will say, okay, convert it to oil. And NNPC will collect the tax on behalf of federal government in the form of oil. So now NNPC is having two sets of oil. They have royalty oil for the government, tax oil for the government. Then the remainder is profits. NNPC will not share in the profits. It didn't contribute, it didn't invest. So the operators will have cost oil to recover their costs, and they will have profit oil to get their profit. So you see here, in PSC, though the monetary value will be calculated, no money is exchanging hands. What happens here is everything is in oil. And now the NNPC will now do something similar it did in joint ventures. NNPC has royalty oil and tax oil, but it cannot lift everything. It will now ask the operators to sell the royalty oil and the tax oil and pay into the NNPC's account or any account that is designated for that. And so that's what we are going to be seeing. So one major difference between the joint venture and the PLC is that in joint ventures, NNPC is an investor. In PLC, NNPC is not an investor. In joint venture, NNPC contributes cash calls. PLC, no cash calls. Joint venture, NNPC bears loss, if any, and enjoys from profits. In PLC, NNPC does not enjoy any profits, neither does it bear any loss. In PLC, everything, every value is converted into oil, but this does not happen so in joint venture. Now, there are other things that are different. Because the joint venture is a different contract from the PLC. The PSC goes deep into the oil basin, or into the ocean basin. That's why it's called petroleum deep offshore inland basin and production sharing contract. That's the full name. Deep offshore inland basin and production sharing contracts. They go up to 2,000 meters into the seabed. They go far deep. And so the petroleum profit tax payable by the PLC shall be a flat rate of 50%. Whereas for petroleum profit tax, it is 87%. All right, so also in petroleum profit tax and PLC, there are capital allowances. is also 50%. But that is not so with joint ventures. Now, in both cases, look at what they pay for royalties. Onshore is land. Any activities done on land, the rate is 20%. When it is offshore is sea. From the top of the sea to 100 meters depth, royalty is 18.5%. When it goes between 100 and 200, it is 16 to 3%. Now, between 201 to 500 meters, it's 12%. As the depth increases, the royalty reduces. Now, when it gets to 1,000 meters, it's 4%. Anything above 1,000 or deeper than 1,000, they pay no royalty. And the computation of these payments and the tax shall be made in US dollars. So petroleum profit tax, everything is in US dollars. But for the purpose of reporting it into Nigeria, it will be converted into Nigeria. But the taxes and every other thing will be done in US dollars first before converting. Right. Now, let's look at some other things here that are pertinent to this topic. I will need to point out some of the things that are needed here. The tax, I mentioned 75% before. I'm sorry, it's 85%. That's the tax rate for the joint ventures. Now, this is going to be when you have stayed more than 4 years. From your 5th year as a petroleum company upstream, you'll be paying 85%. But when you are still recouping for the first 4 calendar years, you will be paying 65.75%. After that first 4 years, you will start paying 85%. That's for joint ventures. But for PSC, whether from the 1st year, 4th year, 5th year, 10th year, you'll be paying 50%. Now, what are upstream activities? Upstream activities. These are activities that are related in acquisition of license to win oil. You first of all get license to win oil. You will now do exploration. You will now get the oil from the ground and associated gas. You will now treat the oil and process the gas. Then you take your crude oil to the transport to the export terminal where it is going to be exported. So maybe you take it to the exporting zone or maybe to the wharf, ready to be exported. And so your activity stop there. So it starts from the licensing to getting the oil in the ground, drilling it, cleaning them, treating it. It is still in this pure crude. Bottling them, putting them in barrels, and taking those barrels to where they will be exported. And upstream ends there. Now the downstream starts where the upstream stops. They receive these barrels, put them into tank or some sea liner and export them. So that transportation that is involved is a downstream activity. Those ones that are not exported, some of them go to the refinery. So going to the refinery is another downstream activity. When it comes to the refinery, when you refine the products to their different derivatives, it's an downstream operator and downstream operation. Then when you now engage in selling of these derivatives, marketing and distributing them, all these are downstream activities. So upstream activities end at the point where it's taken to the borders to be exported. Downstream activities start from receiving it and transporting it to marketing. What are some of the terms in the PPA or PPTA? The accounting period. Now, for petroleum profit tax, the accounting year is always from January 1 to December 31st. So in an exam, you can never see a petroleum company that is not December 31st. And secondly, it is actual year basis, not preceding year, actual year basis. So what happens that if there is any period that is shorter than 12 months, how is it that a period will be shorter than 12 months? If you start an oil exploration before January, or maybe after January, maybe February or March, let's say it is March 1, you started, it must end December 31st for the first year. So this is an example of less than 12 months. Or maybe you are ceasing business after maybe 10 years or 20 years in the business, you want to cease. You want to cease in 2025. Maybe you are ceasing on March 31st. So it will start counting for that year, January 1 to March 31st. That's another shorter than 12 months. So it is at the year of commencement and the year of cessation that you will see that we have shorter than 12 months. Of course, there's no change of accounting date because every petroleum company ends at 31st December every year. The revenue service, when we talk about revenue service, we mean the FIRS. When we talk about casing head petroleum spirit, we mean any liquid hydrocarbons obtained in Nigeria from natural gas by any chemical or physical process before they have been refined. When we talk about chargeable natural gas, we mean natural gas delivered by a company to the Nigerian National Petroleum Corporation under a gas sale contract. We'll see that. When we talk about chargeable oil, it is still crude oil. It is the same casing head petroleum spirit and crude oil that is won by a company from petroleum operations. That is what we call chargeable oil. Okay. Right. So a company is any corporate body incorporated under any force in Nigeria or elsewhere. Look at crude oil. Know the meaning of crude oil? Any oil that is won in Nigeria, either in its natural state or after the extraction of water and sand or other foreign substance from it. So here, you are not refining it. You've brought it to the natural state. You are removing sand. You are removing water. You are removing foreign substance. It is still in this natural state. It's crude oil. Disposed of means delivery without sale of chargeable oil to a refinery. So when you are saying that chargeable oil is being disposed of, it means you deliver it without selling, either to a refinery or to a tank to be refined by a company. Then you'll be hearing us talk about G factor. It is called gas production cost adjustment factor. We'll see this in a calculation sometime. Now, let's talk about intangible drilling costs. Intangible drilling costs. All expenditure for fuel, labor, repairs, maintenance, hauling, supplies, which are for or incidental to drilling, are incurred in respect of determination of well locations, drilling, shooting, testing, and cleaning wells. The long and short of that is they are all allowable expenditures. Intangible drilling costs. Let's go to some other things here. This is a very long topic. I want to crystallize out the important things here, but you can read everything because it's important for you to read them. But the ones I'm sifting out are very much important in passing your petroleum profit tax. Now, talk about nature and classification of income. Now, the main sources of income of a petroleum producing companies are: one, sale of crude oil. So when a petroleum company produce oil, it's going to sell either as exports or to local sales. So you'll be treating export sales. Export sales, you'll be calculating it in dollars and then use the currency exchange to bring it to Naira. The local sales will always be given in Naira. Then there is gas, and it will be exported or also locally sold. Then there is income from lifting and sale of NNPC equity crude. So NNPC cannot lift everything. And NNPC will tell you, please sell for us. So the commission you get is the income for selling that of NNPC. Other items of income, for example, we have interest income, will be earned from activities that are considered to be petroleum operations, incidental to petroleum operations. Incidental income will also be subjected to PPT. Some of the income that could be treated as incidental incomes are ullage fees, rental, management fees, mineral property conveyance, and interest on deposit, fixed deposits. Now, nature of cost. The nature of costs for petroleum activities has been classified under section 10, 9 and 10 as follows. In fact, section 10 gives you the allowable expenditures. We have outgoing on unproductive leases. We have non-productive rent. So when you see rent, both productive and non-productive, they are allowable. Then we have tangible costs directly incurred with drilling and appraisal of development well. So tangible costs. Then we also have exploration and drilling costs. Now, in the case of exploration and drilling costs, more especially drilling costs, it is for the first 2 appraisal wells. So in some exam question, you will see 5 appraisal wells. You just divide it by 5, multiply by 2 to get the first 2. Sometimes they might tell you the first 2 were this, and the next 2 were so and so. All you need to do is that the first 2 appraisal wells is what is allowable. Now, all sums by way of duty, custom and excise duties, stamp duties, education tax are allowable. Now, this is where taxes are allowable expenditure for petroleum profit tax. Now, one thing I must tell you is calculation of petroleum education tax is tricky. It is very tricky. And so when we are solving a question, you need to see one of the major things that you'll be tested is how to calculate petroleum profit tax, education tax. It will never be given to you, but you with yourself, you will need to calculate it. Then all sums by way of custom or excise duties, other like charges levied in respect of machinery, equipment, and other goods used in the petroleum company's operation are deductible. Now, when we talk about interest on any intercompany loans, you know, intercompany loans are supposed to be controlled activities. They are expected to be not at arm's length. But now, if they are done in terms that are prevailing in the open market, it is seen as arm's length and it becomes allowable. Otherwise, it will not be allowable. All right. So exploration costs, development costs, production costs, all these are allowable costs. Now, petroleum profit tax. The ascertainment of adjusted profit and imposition of tax for petroleum company is the focal discourse of this set of discussion. Now, the profit of an accounting period. How will we get the profit from an accounting period? First of all, we need to get all the sales proceeds of all chargeable oil sold and chargeable gas sold. So we said proceeds from exports, imports, even that of NNPC, that the income they get from NNPC's oil and gas that is not able to be picked by them. These are all proceeds from the sale of chargeable oil. Then value of chargeable oil disposed of. So this is the one that you deliver to the refineries without selling. You only deliver to the refinery. The value of the oil, you didn't sell it, but you need to know the value of those oil that you are delivering. Just like saying that you want to give somebody a gift. You know how much it costs you to buy that gift, but you are giving it to the person. So it's the value that we're talking about. Then all income incidental to and arising from its petroleum activities. So these are where the profits will be coming from. Now, coming to value of oil disposed of. Now, this is the oil that we are giving to the refinery. All right. The value of this oil to be disposed of comes from three things. One, the value of that oil as determined for the purpose of royalty. This is the exact cost of the oil. Then any cost of extraction of that oil is factored in. Then any costs incurred by the company in transportation and storage of that oil is determined. The value of crude oil for royalty purposes, you may not be seeing that in the exam, but it's still good for you to know all of that. Now, your adjusted profit is the profit after all deductions of allowable expense. So what you do here is, what are your income? Sale of crude oil, export and local sales, sale of natural gas, export or local sales, any other incidental income. This is on the one hand. You now bring your allowable deductions, exploration cost, salaries, production cost, cost of drilling the first two appraisal wells, non-productive rent, productive rent, and all that you have. And even your tertiary education tax. You bring them together, they all form your allowable deductions. When you remove your allowable deductions from your total income, you have your adjusted profits. All right, so all these pages I'm passing by, these are all allowable deductions. You need to read them compulsorily. We have rents, we have royalties, we have other things there that will make good reading. Now, non-allowable deductions. Some of the non-allowable deductions are any disbursement or expenses that is not meeting the REN criteria, that is not wholly exclusively paid out or exclusively incurred for petroleum purposes, especially upstream, it's not allowable. Any capital withdrawn or any sum employed to be employed as capital, this is also not allowable. Some of these definitions of non-allowable are also that in for company income tax. Any sum that you can recover under insurance contract of indemnity is not allowable. Rent of or cost of repair to any premises that is not intended for the purpose of petroleum operations, not allowable. Any amount incurred in respect of income tax, profit tax, or other tax, whether charged within Nigeria or outside Nigeria, are not allowable. So income tax, profit tax, CGT, they are not allowable. Depreciation. because it's the chief not allowable. Now, any payment to any provident, savings, widows and offers, or other societies scheme or fund not approved by the board, it's not allowed. So take time to read some of these not allowable provisions. Now, accessible profit or loss. The accessible profit of any company will be the profit that you get after your adjusted profit has been done. So adjusted profit is the income less allowable deductions. Now, accessible profits will now come in when you are having loss relief. When you have loss relief, you take out your loss relief, then it's pure accessible profit. Your chargeable profit is when you remove your capital allowances. Now, for the purpose of capital allowances, it shall be the lower of two things. The lower of your capital allowances, which is the A part, your capital allowances brought forward from previous year. You will now add your annual allowance for the year. Of course, for petroleum companies, any assets that is, in the case of company income tax, you look at the assets and you want to check annual allowances based on percentage. You will now have initial allowance and annual allowances based on different percentage based on the assets. But in the case of petroleum company, all of them are treated as one kind of asset, treated the same way, the same rate. And you can claim for only 5 years. So the first year will be 20%. All your assets, 20%. Second year, 20%. Third year, 20%. Fourth year, 20%. When it comes to the fifth year, you must take only 19%. And just 1% will be left in your books until the asset is disposed of. So that's the annual allowance. It's always calculated as 20% for the first 4 years. For the fifth year, it's 19%. For the sixth year and above, no annual allowance will be claimed. Then there's what we call petroleum investment allowance. Petroleum investment allowance has a special calculation. Then we have the investment tax credit if applicable. Remember, we'll come to this petroleum investment allowance later. Now, when you add all of these together, you get a particular figure. That forms your A part of your capital allowance. Now, you are judging two things. Whichever gives you the lower answer, that is your final capital allowance. So you have gotten your A part, all your capital allowances brought forward, annual allowance, petroleum investment allowance, investment tax credit. Bring them together, you got something. The second part is a calculation. You look at your accessible profits, you find 85% of it. Then you minus 170% of your petroleum investment allowance. And when you have done that, you have your number B part. Anyone that is lower, that is what will be your capital allowance. Now look at the format here. Profit for the period. You deduct allowable expenses. So this profit for the period is like income for the period. You deduct allowable expenditures according to section 10. Then you deduct education tax. you find your adjusted profit, you less the loss relief, it gives you accessible profit, then you deduct capital allowance. Then you have your chargeable profit, of which you will be charging tax of 85%. Now we said annual allowance, as we mentioned before, it is 20% each year. For the 5th year is 19%. Now, petroleum investment allowance. Petroleum investment allowance, when it comes to joint ventures, petroleum investment allowance, when it comes to joint ventures, you'll be looking at where the activity takes place. If it is onshore, that is land, it is 5%. If it is offshore, from the top of the sea to a depth of 100 meters, the rate is 10%. When it is between 100 and 200 meters, it is 15%. When it's above 200 meters, it is 20%. Now, note something about investment, petroleum investment allowance. Petroleum investment allowance is chargeable once, just as we have annual initial allowance in CIT. This is the same way. Investment allowance is charged once on the first year that asset is put into use. And so what happens is that if you are dealing with a company, petroleum company, that you are finding their reports for 2024, and you see that they bought assets on 2024, you must calculate petroleum investment allowance on those assets. And you have to calculate annual allowance too. But any asset that is not purchased that year cannot enjoy petroleum investment allowance. Means that it's enjoyed it before in the year it was purchased. Now, this rate is applicable to only joint ventures. Then, of course, we have balancing charge and balancing allowances. Balancing charge is when you sell off the assets and you sold it more than your tax written down value. The excess is being charged. Balancing allowance, you sold it below the tax written down value. And so the difference is your allowance. So we've seen some of these things here. So, ladies and gentlemen, this is what you need to know about petroleum profit tax. Then there is that of gas. Okay, so let's come to, before we go to gas, there's something called posted price and adjusted price. Let me tell you about that. Posted price, you'll see it in some questions. What do you mean by posted price? Is the price free on board at the Nigerian ports of exports, and there is a gravity of quality of that oil. So it means that the posted price is the price for a particular oil, crude oil, with a particular gravity. So when that gravity is determined, that is a posted price. So when you are hearing petroleum price that this is so and so price per barrel. What they are failing to tell you is what is the gravity, what is the API gravity. The API gravity is determined by the sulfur content in it. So what is the API gravity? Now, when they have a particular standard gravity and the oil you are bringing fails to meet that standard, either it is higher than that or lower than that, your prices will need to be adjusted to meet with the gravity you bring. So if the gravity, the standard gravity is 50%, assuming, and it is for 1,000 US dollars, and you bring 40% gravity, and if you are told that for every percentage difference in gravity, for every 1% difference in gravity, or 1 degree difference in gravity, the price adjustment maybe is $20. So now there is a 10% fall in gravity. 20 times 10 will be 200. So you remove 200 from whatever posted price the standard was. So that is how your price will be. So that's what we call posted and adjusted price. We'll see that next week, next class. Some of these questions we are seeing here, we'll take them. We might also take a past question if need be. We go to associated gas or gas contract, and that's where we'll call it a day for today. Please read everything because it will help you in other topics that we've done. Just a moment. You can see most of the topics that we are selling, that we have discussed are also here. Now, when we look at the value of natural gas, gas is something that evaporates. And so when you say you have 10 maybe CL or liters of gas, it may actually not be that because there's an allowance for some percentage of gas to be deducted based on the activities. And so there is a gas factor table. Now you see gas factor from 50 to 80 to be given to you in the exam, and look at the percentage. So these are the percentages of allowable deduction for gas production, value of gas. So when you are given a gas contract, you'll be given the load factor, and you'll be asked to look for the percentage. Sometimes your load factor might not be exactly 50 or 60 or 70 or 80. it could just be 65. And when it is 65, for example, you cannot find it in the table, but you can calculate it by interpolation. You simply say 65 is between 60 and 70. So that means 65%, the 65 gravity will be between 14.3 and 15.5. There's a way you do it using extrapolation method, and you get the percentage. We'll do all of that when we're solving a question. So that's it for petroleum profit tax, also called oil and gas taxation. In our next class, we are going to do little talking, but more of solving questions. And then you will see how these are being tested in exams and how to pass questions in petroleum profit tax. Now, these questions from this topic is a short question to come up. Sometimes questions from this topic comes out two times in a single diet. So make sure you learn how to do, especially computation part or some explanation to do. Then you'll be sure to make good grades on that. With that, we come to the end of today's class. Come prepared on our next class where detailed solution will be given. If you have any question, you can say it now, or you may wait to chat me privately so that we can handle that. So what is it going to be? Okay, so the questions should all be sent to me privately. I don't think now you have any question until we start solving questions. So thank you once again for coming to class and for taking the time to listen to me. The recording will be available to you. So do have a nice and productive day.